While you are holding cash in your bank or brokerage account, money market ETFs are quietly paying 4 to 5% annual yields with virtually the same safety as cash. Listen, they called me crazy when I built this six-figure portfolio yielding 25% plus in just 3 years. But here's what most investors don't understand. I'm an ex-financial advisor who helped allocate over 10 million euros in assets across Europe. Now I create content on YouTube, no consultations, no sales pitch, just raw strategies that actually work. But let's get back to the problem itself. You are building a high-yield portfolio, maybe using leveraged ETFs, dividend stocks, or covered calls. As a smart investor, you always have some cash in your brokerage account waiting for the opportunity. But this cash position is doing nothing for you. It's dead money. Today, I'll show you how money market ETFs can turn that safety net into a profit center while you wait. Welcome to Psycho Investor, where we turn conventional wisdom upside down and build wealth aggressively but intelligently. Today's episode is crucial for anyone serious about high-yield investing. We are talking about the foundation that lets you take bigger risk elsewhere, your cash position. So, while traditional savings accounts in Europe pay 0.1 to 1%, money market ETFs are consistently delivering 4 to 5% yield. On a 50,000 euro cash position, that's the difference between 500 and 2,500 euros per year. Free money, essentially. But here where it's get interesting for us, high-yield hunters. Money market ETFs are exchange-traded funds that invest in ultra-short-term, high-quality debt securities. Think government bonds maturing in days or weeks, not years. Here is what's inside a typical European money market ETF. Government treasury bills 40 to 60%. High-grade corporate commercial paper 20 to 30%. Repurchase agreements 10 to 20%. Bank certificates of deposits 5 to 10%. Now, why should a psycho investor care about something so boring? 3 reasons. First, yield enhancement. Let's say you maintain 20% cash in your portfolio for opportunities or risk management. On a 100,000 euro portfolio, that's 20,000. At 4.5 yield, you are making 900 euros annually instead of 20 in a savings account. Second, liquidity on steroids. Unlike term deposits or saving accounts, you can sell these ETFs instantly during market hours. When that perfect high-yield opportunity appears, boom, you are ready. Third, volatility buffer. When your leveraged ETFs are swinging 30% in a month or a single week, these barely move 0.1%. It's like having a shock absorber in your portfolio. In March 2023, when Credit Suisse collapsed and financial ETFs dropped 15% in 2 days, money market positions actually increased in value as investors fled to safety. That's the beauty of this strategy. Now let's get technical. These aren't your grandfather's bond funds. Money market ETFs exploit the short end of the yield curve. When central banks raise rates to fight inflation, these funds benefit immediately. The European Central Bank raised rates from negative 0.5 to 4.5 between 2022 and 2024. Money market ETFs captured the entire move while long-term bond funds got crushed. Here are my top picks for European investors. Number 1. Xtrackers Euro Overnight Rate Swap ETF, ticker XEON. Current yield at 3.85, total expense ratio 0.1%, assets under management 4.2 billion euros. It replicates the euro short-term rate. Number 2 is PIMCO US dollar short maturity UCITS ETF, ticker MINT. Current yield is 5 to 5.3% in dollars. Total expense ratio is 0.35%. Holdings, investment-grade corporate bonds, and government securities. Average maturity, less than 1 year, and it delivers monthly distributions. Now, why PIMCO? They are literally the bond kings. This ETF gives you active management in the short-term space, higher yield than pure government, treasury bills, investment-grade corporate exposure for extra yield, and monthly cash distributions, perfect for reinvestment. What's inside this ETF? Short-term corporate bonds 40 to 60%, US Treasury bills 20 to 30%, government agency securities 10 to 20%, and commercial paper 5 to 15%, all with average maturity under 1 year, which delivers minimal interest rate risk. Yes, it's dollar denominated. For European investors, this means currently capturing that sweet 5% plus US yield. Currency risk exists. Euro compared to dollar moves with impact returns, but here's the psycho angle. When markets crash, dollar typically strengthens. This becomes both a yield play and a crisis hedge. So now, if I compare Euro money market versus PIMCO USD short maturity, well, European funds delivering 3.85% yield, zero currency risk. PIMCO in dollars delivers 5.2% yield, actively managed, and has currency exposure. The 0.35% total expense ratio is high, but active management in volatile markets can add value. Now let's talk risks, because psycho investors face reality. First, interest rate risk. When rates fall, yields drop instantly. But here's the thing. The capital value stays stable, unlike long-term bonds. Second, credit risk. Minimal, but not zero. These funds hold AAA to A- rated securities. The 2008 crisis showed even safe assets can fail. Third, currency risk. Critical for European investors. Unhedged dollar exposure. But PIMCO's active approach means they can navigate rate changes better than passive funds. Plus, that dollar exposure saved my portfolio during the 2022 energy crisis when euro tanked. Let me show you how a hypothetical high-yield investor might structure their cash position. Imagine a portfolio of 100,000 euros. High-yield positions, 75%. That would be 75,000 euros. Cash and money market allocation, 25%. That's 25,000 euros. Here's how that 25,000 could break down. Emergency liquidity for 1 month of expenses, 3,000 in instant access savings. Opportunity fund, 10,000 in money market ETFs. Volatility buffer, 12,000 in money market ETFs. So how to implement that? Step 1, calculate cash needs. Take monthly expenses times 3 for the emergency fund. Add 10 to 15% of total portfolio value for the opportunity fund and add another 10 to 15% for the volatility buffer. Step 2, choose your ETFs. For amounts under 50,000, one broad money market ETF works well. For 50,000 to 200,000, consider splitting between 2 to 3 ETFs. Above 200,000, direct treasury purchases become an option too. Now here's where it gets psycho. Try the ladder strategy. Instead of one money market ETF, consider creating a ladder. 40% in overnight rate ETFs for maximum liquidity, 30% in 1 to 3 month ETFs for slightly higher yield, 30% in 3 to 6 month ETFs for maximum yield. This approach provides both instant liquidity and enhanced returns. Picture this scenario. NVIDIA options present a 35% monthly opportunity. An investor could liquidate 15,000 euros from their money market position in 30 seconds. Try doing that with a bank deposit. Here's how money market ETFs can supercharge high-yield strategies. Covered call enhancement. When writing covered calls on stocks, premiums vary wildly. An investor keeping 20% in money market ETFs can buy more shares when implied volatility spikes. Second, leveraged ETF management. 3x leveraged ETFs can drop 30% in a week, sometimes even in a day. Having that money market buffer allows rebalancing without panic selling. Third, dividend capture flexibility. European dividend seasons are pretty much predictable. Smart investors could move from money market to high dividend stocks just before X dates and then rotate back to safe. Consider this hypothetical portfolio performance. Q1. During market uncertainty, 35% allocation to money market earnings, 4.2%. Q2. Deploy 20% into tech calls, achieving 85% return. Q3. Rotate profits back to money markets. And Q4. Use money market funds to buy the October dip. Potential total return could reach 24.8% versus 18.2% without the money market strategy. For European investors, the advantages multiply. We do have full protection under UCITS regulations, Plus, many brokers accept them as a collateral for margin trading if needed. Now let's talk about risks. Money market ETFs are not bank deposits. No government guarantee. They are safe, but not bulletproof. In extreme crises, even these can lose value temporarily. Always check the underlying holdings before investing. Some money market funds take more risks. And keep in mind that currency hedging cost can eat into returns for non-European funds. My rules for total portfolio: never less than 10% in cash or money market ETFs. You need dry powder. Never more than 40%. You are here to make money, not preserve the cash. Increase cash or money market allocation as you age or portfolio grows. Let's recap what we've learned. Money market ETFs turn dead cash into 4 to 5% yielding assets. They provide instant liquidity for opportunities. They perfectly complement high-yield strategies, and they are essential for managing portfolio volatility. Think about this transformation. At 100,000 portfolio, 25% cash earning nothing equals nothing versus 25% money market position earning 4.5% equals 1,125 euros annually. That's over 1,000 euros of free money on 100,000 portfolio to fund your next investment. Look, they called me crazy for leaving traditional financial advisory to share these strategies on YouTube. But seeing portfolios grow using these techniques, that's what drives me. But knowing this strategy is one thing. Implementing is what creates wealth. Every day your cash sits in a savings account, earning nothing is money lost forever. So if you are ready to stop letting your cash position drag down your returns, use money market ETFs, but use them wisely. Another case, if you're just sitting on a pile of cash, click the link in the description to open your investment account and start earning 4 to 5% on your cash today. If you found this video valuable, subscribe and hit the bell. And remember, the difference between dreamers and wealth builders is action. That link in the description is your first step to turning every euro in your bank account into a profit machine. This is Psycho Investor. Stay aggressive, stay smart, and stay psycho. This was not a financial advice. Always do your own research and remember that past performance doesn't guarantee future results. See you in the next video.